This presentation will concentrate on some economic forecasts. I'm not an economic forecasting specialist, so instead of being a weatherman that's going to tell you what's going to happen to the EU in the next 6 months, I'm more like a climatologist who will speculate on what it may look like in the more distant future. This is certainly a nervous time for Europe and for Italy, and one which I think will challenge the talents of asset managers. You're certainly going into a very high-risk period, and so I will, after commenting on the economic futures, make a few comments on prudent asset management in this highly volatile environment. First of all, we do seem to be flirting with a global recession, another global recession coming from several sources. In particular, there is an issue of the fiscal cliff in the U.S. There is an issue of whether the rapid Chinese economic growth will continue, and of course there is the very substantial issue of the stability of the euro and the economic future of the EU. Now here's a diagram. These are from IMF forecasts published in late October, and a few comments on this. First of all, in a little darker shade of blue, you see the relatively short formal recession that was caused by the financial crisis in 2008. That has been followed, particularly in the EU, by the debt crisis, which by IMF dating would have started in the early months of 2011 and should end by the end of 2013, maybe. Now, a few interesting features about this particular diagram. First of all, China. This is GDP relative to 2005, so this is taking out the quite large differences between countries. China is in a different world than everyone else. You see that their growth rate did begin to slow around 2006. That's a fall from 13% to about 9 or 10%. But nevertheless, they are rocketing ahead, and we'll see if that we'll make some comments on whether that will continue. The U.S. was heavily hit by the financial recession, and it has been slowly recovering since. Now, what's true in Europe, Germany has also recovered fairly nicely, but the Mediterranean countries, particularly Spain, Italy, and Greece that are shown on this diagram, have done much less well. And here's Italy, and according to IMF forecasts, Italy is in for a continuing recession for about the next year and a half, and then a very gradual return. So that's all, I think, rather discouraging, given that you're not starting from an economy that's robust to begin with. Of course, the saddest curve on this graph is Greece, and the upturn in this graph may actually be optimistic. So I will talk about some of these specific worries. First, the U.S. recovering the fiscal cliff, which I won't have to spend very long on. China's economic slowdown and structural issues, which are likely to be factor in the future. And then finally, mostly EU austerity economics and Euro issues. The U.S. Recovery has been rather slow, and there's been a lot of discussion of what the fiscal cliff is and with the dangers that it poses. Just to remind you, this thing that's called the fiscal cliff is the result of a political impasse, and the consequence of that impasse is that on January 1st, income tax rates will go from current levels to back to 1990 levels. That all in all, that's not a huge increase in taxes, but it is definitely a shock to a rather fragile system. It also lowers government spending quite substantially, and again in a way which was designed to be to shock the system and be unacceptable. That was supposed to break the political impasse. It has not done that so far. The consequences of the fiscal cliff are a bad short-run impact on recovery of the economy. It must be said that if you look at the long-run structural consequences of the fiscal cliff, the increased tax rates and lowered government spending, the magnitudes are actually about what's needed in the long run. But this is done in a very arbitrary and unbalanced way. To understand the consequences of the fiscal cliff, here is a diagram of U.S. GDP and potential GDP, full employment GDP. You see the effect of the financial crisis and the recovery of the U.S. economy, which has been pretty slow up until now. This is a diagram which assumes that the fiscal cliff will not occur, and if the fiscal cliff occurs, the projection is that it will definitely slow down the U.S. economy, perhaps not throw it into an official recession, but to slow it down by 0.5 to 1% growth rate from what is already a pretty anemic growth rate. The fiscal cliff is a solvable problem. It's simply a problem of politicians unable to come to conclusion, and what one can hope is that the U.S. Congress will behave itself better in the future than it has done in the past. By the way, here's just one final diagram. This is from the Congressional Budget Office, official statistics. Here's the scenario if the fiscal cliff is avoided, and here's the scenario if it's enacted. And you see that from the standpoint of federal debt, the fiscal cliff would be a good thing, at least in the long run, in terms of avoiding an unsustainable continuing rise in government debt in the U.S. But the consequence of this, short-run consequences, are quite unfortunate. Let me turn secondly to the problem of China. China has a slowdown, and it also has some serious structural imbalances. Now, the slowdown is of the following form. Growth rates in China have come down from above 10% to around 8%, still the envy of everyone else. And over this year, it has been falling steadily. There are perhaps some indications that the slide in growth rate in China has stopped. But one of the issues for China is that most of its growth is generated through exports, and you can't export very easily to a global economy that's in deep recession. So China itself is being affected by the global economy. Now, I said that there are structural imbalances in China, and here's one of the largest. Because of its strong emphasis on exports, China has pursued policies which have decreased consumption as a percent of GDP from over 60% in the 1950s perhaps not very accurate data at that time, to now around 33%. That is an unprecedentedly low percentage of consumption in GDP. Most countries are around 50 to 60%. This is not sustainable. It's caused by a very aggressive and unbalanced export promotion, and China recognizes that it has to change its structure substantially to improve domestic consumption. That will have the consequence of that can only happen if Chinese wage rates go up. That actually has some important global implications. One of the consequences of very high export-led growth in China is that it has drawn manufacturing jobs from all around the world. It buys raw materials, but it has drained away manufacturing jobs in many countries. As it changes structurally, several things are going to happen. First of all, that some of the other developing countries are going to do better because they can compete and now sell goods to the Chinese consumers. And secondly, some economies, even some economies of the periphery of Europe, should benefit from higher Chinese wages and less pressure on domestic production. Finally, I'll talk about austerity and recession in the EU. Seems to be a popular policy in many countries in the EU to deal with the debt crisis with programs of austerity, reduced government spending to reduce government borrowing, and so forth. In some cases, this is involuntary, as in the case of Greece. In others, it's deliberate policy. For example, in Spain. And the EU, led by Germany, has resisted monetary loosening that has the potential to become inflationary, although in the current conditions it wouldn't necessarily be so. And the consequence of this monetary loosening has been accepting slow growth and shrinking peripheral economies. So one question that natural for an economist to ask is, can austerity work? And is the recession that seems to be coming out of austerity worth it in terms of will it achieve stability in the future? Just in terms of short-term growth rates, what you see is, of course, a very sharp drop in growth rates at the time of the financial crisis in 2008, but now, beginning in 2011, a slide back into pre-recessionary or recessionary conditions as a consequence of the debt crisis and the liquidity, the deleveraging and liquidity crisis that's come with that. Now, most of the problems that have worried investors have been around the Mediterranean. Of course, Ireland and Iceland are other maritime countries. There's something about being close to water which seems to cause problems with the euro, or perhaps problems with banks. Yeah, here is a diagram which is already a little bit out of date. It's a 2010 diagram, but what you see, yeah, there we are. What you see is that, of course, Greece, which is a relatively small country, has a very high public debt to GDP ratio, and it has remained stubbornly high despite enforced austerity. Oops. But on a much larger economy, the Italian economy also has high public debt, even higher than some of the other large economies. So it is certainly vulnerable to volatility and to speculative attacks. Now, one of the issues with the debt crisis in Europe is short-term stabilization, and the emphasis so far, all the attention has been on Greece, but this little cartoon shows that some people might ask, is it a Greek problem or is it a Roman problem? One question is the euro going to survive? It's certainly a question which is going to be an important one for anyone who is managing investments held and denominated in euros. There are really three possible futures for the euro. Red is bad, green is good, I think. One possibility is devolution, so Greece goes out of the euro, presumably by defaulting and reverting to a national currency. The result of that would be Portugal, Italy, and Spain coming under a great deal of pressure, which doesn't necessarily mean that they would be forced out, but it would certainly require challenging adjustments, probably a very difficult liquidity crisis, and elevated default risk, and perhaps even more extended recession. A second possibility, I don't know how serious it is some bifurcation of the euro into what one might call a Nord euro and a Sud euro. So Germany and other countries such as the Netherlands would form a new currency union. The remaining countries might remain in the old euro currency union, and those two would float against each other. I've heard people, serious economists in Germany, suggest that as a possibility, but it involves extremely difficult issues. For example, suppose that a German bank loans money to an Italian bank in the current common currency euros. Suppose now that either Germany or Italy were to leave that common currency union and form their own currency union. How does that debt get denominated? Does it get denominated in Nord euros or Sud euros? It makes a big difference. Finally, there may be maintenance. One hopes, I think, for those who are in favor of the political objectives of the EU and also recognize the economic advantages of scale of the EU. The euro was the first card played in a game which was to lead to an integrated economic superpower. And so one would hope that program could be carried on through. Now, what's that going to require? It's certainly going to require, I think, in the end, a haircut for holders of Greek bonds, no matter what the Germans say. It's also going to require, I think, that a lot of the public debt in Italy and Spain and other places is either going to have to be inflated away or forgiven. I don't see growth in Italy happening in a time frame which would make it easy to get out from under its current debt. So in any of these, fiscal harmonization is required, although I think as the previous speaker said, fiscal harmonization itself may be necessary to avoid speculative money flows across borders, but it's really not in the end, it's not the answer alone. There are other kinds of adjustments of a much more fundamental nature are going to be required. And here's a diagram which I think illustrates what I see as one of the fundamental issues with the currency union as it's currently structured. This is a graph which shows unit labor costs in Spain and Italy and in 15 core EU countries relative to Germany. And those unit labor costs have been going up steadily. Now, what that's saying is, of course, that productivity in Germany has been going up more rapidly than productivity in these other countries. When you're in a currency union, the only adjustment left for these economies is deflation in prices and deflation in wages. And what we've seen is that seems to be very difficult for the peripheral countries to carry out. But I think without that kind of adjustment, I do not see how the euro is viable in the long run, even with fiscal harmonization. I think deep structural changes that allow the peripheral countries to lower their overall price levels and overall wage rates is going to be needed if the euro is to survive. I skipped that one. This is just another diagram which shows the degree to which prices in countries like Italy and Spain are now out of line. Ordinarily, if they had individual currencies, you would have that were floating. You would see these currencies presumably devaluing to bring current account into some kind of balance. That's not it's not possible. The only way that can happen is through either cuts in wages and prices, or it could be achieved by some level of inflation in the overall EU, in the overall euro. The thing which would probably the most painless way to deal with the debt crisis, but one which so far has been blocked by Germany. This is a diagram which I don't. There's things about this diagram I don't agree with. It sets a 180% threshold as some notion of what's an appropriate amount of leveraging of an economy, 180% of GDP. I don't think that's a realistic number. What's appropriate leverage for a particular economy depends on who's doing the borrowing, who's doing the lending, and what the prospects are for servicing the debt. But it is useful in illustrating something about the magnitude of the claim on wealth that these debts represent. And what you see is for Italy, the claim on wealth is about 24% of the wealth of Italy is would be claimed by its current debt. Italy, of course, has lower, fairly high government debt, but a fairly low household debt, and is by these standards is not out of line with other countries. Well, let me conclude by making a comment on asset management, and I'm a real economist as opposed to a monetary economist, and so I would like to phrase this in real terms, which is you can view setting up a pension system as one in which a worker passes up a bottle of wine for lunch and puts it into storage, and 30 years later, when retired, takes it out of storage to consume in retirement. That all of that it could be viewed as a real goods transaction. Now, pension funds are essentially the organizations that manage this inventory. And of course, the inventory is not held in bottles, although perhaps sometimes it should be. And the financial instruments get involved, and the risk of financial instruments get involved. But I think a very fundamental observation is that the financial side of the economy should not get in the way of the real worker giving up his wine in order to get it during retirement. What are the implications of this? And they are, first of all, that in a pension fund, what you want to do is move a person's real income from work to retirement with minimal risk relative to the real economy, and in effect, you want to try to have those assets, those contributions, grow at the real per capita growth rate of the economy, and that really should be the target. I might just mention that in terms of what pensions do, the standard pensions, at least the ones that I know, are either defined benefit plans or defined contribution plans. One could think of something in between, in which what the pension system would do is ensure that relative to their age cohort, people are able to maintain their standing, and that should be a lower risk way of running a pension system than either a defined benefit or a defined contribution system. So what are the implications of my little real economist riff on pensions? First of all, I think that one should not expect or seek real rates of return that are higher than the Italian real rate of growth per capita. That's to say, in order to keep Italian workers happy when they're retired, they should be satisfied, and you should be satisfied if you can keep them in their relative position in the economy. That is an implication that diversification outside the Italian economy should be handled with care. There are obvious advantages to diversification, and in a situation where the euro is problematic, and there's a lot of exposure of Italian institutions to euro debt, diversification is certainly called for. But in the end, what you need to do is bring these assets back into Italian real units. And finally, I think you're coming into an era where it's going to be very important to hedge, and particularly look for assets that can survive any euro future, but beware of bankers selling derivatives and of hedge funds that may have rather high performance risk. A good axiom, I'm sure that Ben Franklin would have said this had this been an issue at the time: fully insured long-term returns higher than the rate of growth per capita are too good to be true. Okay, thank you.